It's not every day that I get this excited to make a YouTube video because there's so much that has happened. There are so many updates to my portfolio and things I get to showcase in this M1 Finance dividend growth portfolio that has changed, as well as the growth portfolio, and then of course the quick shout out to my channel. If you don't know me, if you haven't watched my channel, I'm a very small creator. Generally, I get around 5, maybe 10 at the most subscribers in a day, and I'm filming this on October 2nd on Sunday afternoon. This video popped off with Realty Income, and I've been getting hundreds of subscribers a day, thousands of views per day, and this is far beyond what I'm ever expected or ever used to. So thank you so much for subscribing, and if you're new to the channel, hopefully I can impress you by showing what I know, what I'm able to create, and then hopefully provide some entertainment for you guys that I normally wouldn't be able to give otherwise. So if you enjoy this, if you like this type of updates, this is the videos that we will like to put out moving forward. And without further ado, let's go ahead and get started with these updates. So first off, the last time we updated this balance was September 1st of 2022. Now we get to put in October's, which is right here. 37,174 is what we finished out for the 1st of October, which is yesterday. I'm filming this on the 2nd. So this did go down about $1,000. That isn't the greatest of performances, but considering that the market went down heavily during that time, it's not that bad. Over the last month, this was our performance right here, negative 4.85%, which is not very good, but considering that the S&P was down 9, the Dow was down 8, the NASDAQ was down 10, and the Russell was down 9, that's not bad considering we only had about half the losses compared to the other indexes. And here's our year-to-date performance. If you want to see this, you can pause the video right here. But this video is not only showing about performance, but it's also showing about the new investments. The changes we made are mostly behind this Google investment. We made a change to the growth portfolio, which is right here. We did add another holding. We originally had Salesforce and Amazon. Those were the two big dogs. We decided to add a small Crocs position as it came down to the $70 range. As you can see, it's down almost half year to date. We bought some in the 70s, and now we decided to add another Google position, and I bought 100 shares at $97 a share. And this company is down 34% year to date, and considering where this company was at a year ago, at around $150, $160 a share, picking it up for $97 is an absolute steal in my opinion. And so this is what the pie looks like as of today, the time that I'm filming. We have 42% Salesforce, 33% Amazon, 14% Google, 10% Crocs, and that is represented in this portfolio right here. Now, I know what you all came for. Most of you watch this for the dividend growth portfolio, and real quick, you just saw the growth portfolio, and now that we're jumping into the dividend growth, if you want to see this yourself, if you want to invest in it yourself, the links are down below in the description. 126 people have signed up for it so far, so check that out down below. Go click the link, sign up, and get a free $10 and help support the channel. But without further ado, let's go ahead and jump into the dividend growth portfolio. And we'll go in order from the largest to smallest holdings. The top one being time for the largest position, which don't be surprised if I end up increasing this over the next month, is WP Carey, ticker symbol WPC. Now, WP Carey is one that is a real estate investment trust, and it is so rare to see a company fall at this pace. Now, you see during 2020 when this company was in a free fall, but generally this company is really stable, and now it has wiped out about 5 years worth of gains, only up 3% in that 5-year period. Now, this company has a massive dividend yield of 6%. It's not very often you see a company of this level yield so high. Now, I've made many videos about WP Carey in the past, as well as with many other of these dividend companies, but if you look at the dividend history behind this company, it is incredible. From $1.06, $1.05, $1.04, it gets raised not every single year, but every single quarter. Notice that this says September, this says June, this says March. Every single quarter this dividend's getting raised, not every year. So that's one of the benefits to owning WP Carey. It's a real estate investment trust, and over time, as this company raises more shares outstanding, as it raises more cash, and of course collects rent, if you look on an annual basis, the free cash flow over time continually goes up, and even the free cash flow per share, if you factor in the share dilution, still outweighs the growth that this company is experiencing, which creates more profits for you, the shareholder. It's a great dividend yield. It's one of my favorite investments in the entire stock market, and it's one that's often overlooked because it's not super sexy, hot industry that people like to talk talk about, but real estate is a very tried and true proven method of creating wealth for the long term. Now, JP Morgan, another one that I feel like has been overlooked here in 2022. Year to date, this company's down 34%. And when it comes to the bank, I think that the big banks are normally kind of old school. A lot of times they've fallen behind the trends, and I think that JP Morgan is one of the few exceptions. I don't look at this company, and let's hop over to M1 Finance here, and let's go to the research tab. I don't think that this is like a ticker symbol WFC, a Wells Fargo, which also, by the way, I might mention, the 5-year performance for Wells Fargo is vastly different versus a JP Morgan because a company like Wells Fargo does not have the same type of quality. I think the same thing can be said of, like, say, a Bank of America, ticker symbol BAC. This company is not the same quality, in my opinion, as a JP Morgan Chase, and it trades for a premium for a reason. It's a better run bank, and they're more invested in the future trends moving forward with online banking and mobile platforms and cryptocurrencies and all different types of things that the younger generations are moving towards. Now, furthermore, this company has a balance sheet that is a financial fortress. It's not very often that you see companies with these type of financial balance sheets. If you look at their cash and debt, of course, this also includes customer deposits, but as of the most recent quarter, they had $891 billion on the balance sheet, and then the debt, of course, was around half of that at $400 billion. Now, this company has grown its long-term track record, as you'll see with basically all of these companies. Last year in 2021, they finished out with $121 billion, which is an increase for year after year after year, going back pretty much since the financial crisis when this company hit a peak. Now, not only that, but this company has raised its dividend over time ever since that horrible cut back in 2009. You can see that it got a little bit shaky during the financial crisis and during the pandemic, but generally speaking, it's going up over time, and you can see that from this massive rise, now at $1 per share per dividend every single quarter. And then, of course, the shares outstanding has been dropping over time as they bought back more of the company, originally having about 4 billion shares outstanding. Now to the most recent quarter, you can see that they only had 2.962 billion. So on a steady line down, they're buying back their own shares whenever the Fed and the government allows them to do so, which I think we'll be doing heavily within the next couple of years. Now, JP Morgan's one that I like. It's at a great dividend yield at around almost 4%, but it's one that I think is also a good investment as well. Now, Realty Income, I won't go over this too long because, as I mentioned, with my channel popping off, almost all my views came from one video, which is that Realty Income video, which is taking off like crazy. You see in the last, the last 48 hours, we have 15,000 views, about 14,000 of that coming from Realty Income. So most of you saw my video on that. If you haven't, go ahead and check it out. But Realty Income is at a unique opportunity similar to that of WP Carey, where it has just fallen off a cliff. It's falling like a rock, and it is very rare to see real estate investment trust of this quality do just that. Now, the one unique thing about this company is that in the same way we talked about WP Carey raising its dividend every quarter, it does the same thing, raises it at least once a quarter, but this company does not pay dividends out every quarter, it pays out dividends every month. So you're getting continual checks month after month after month, every single 30 days. You can see September, August, July, June, May. It shows up in your cash balance month after month after month, and you can see over time how it continually increases. Let's just go back, say, 5 years. Let's look back to 2017. Back in October, it was paying 21.2 cents. Now it is raised up higher and higher up to 24.8 cents. So continually rises up, as well as that special dividend cash and stock deal that they did with their recent merger just about a year ago. Now you can see that this company has hit a hard time here in 2022. Year to date, it is down 19.07%, but I think now is a buying opportunity. If you don't like the stock, if it's not one you're interested in, that's okay. It's not for everybody. But if you like real estate and you like buying them at a discount at a higher dividend yield than you would normally, it currently yields 5%. So if they maintain this dividend payment and don't do anything else, you'll make 5% on your money just to sit and wait. Now, next up, we have the company called Lockheed Martin. This one was a little bit of a hedge with the war going on, but regardless of what happens with Russia or any of the other geopolitical issues, this is a company that I think is heavy undervalued. Now, if we look at the long-term financial metrics for this company, it matches up with most of the other companies you'll see in this portfolio. Continually rising top-line revenue as well as bottom-line profitability. Looking at that free cash flow continually rising as well as the free cash flow per share. A rising dividend that's just an absolutely beautiful chart going back to about 2003 when they started raising it from 11 cents to today's $2.80. That is a huge ramp up. What is that? That's like a a 100x, literally. No, that's a 200x. That's ridiculous. So you can see that this company continually rises up. It does incredible performance, and over a 5-year period, despite its downturn, it's still up about 25%, not factoring in dividends reinvested, so it would probably be more so closer to around maybe 50% if I had to guess. But this is one that I like. It's one that's high quality, and it pretty much runs the entire United States Air Force as well as a bunch of our military. Visa is one that I've always liked on the channel. If you've watched me since April of 2020, back when I started this portfolio right here with my minimal $1,500 investment, you can see that Visa is one that has always been near the top of my portfolio because it's in a long-term secular growth trend. And one of the things I love about Visa is the incredible financial metrics that you really can't find with almost any other company out there. If we pull up ticker symbol V here, you can find Visa stock, and let's go to the annual ratios. Now, what I want to pull up is not the return on capital employed you see here. What I want to pull up is the operating margin and the profit margin. The operating margins of this company run at about 66% as of the last year. Mid-60s is the standard for this company for the last half decade or so. The profit margins, which is what actually hits shareholders' pockets, runs at about 50%. So for every dollar of revenue they make, they keep about 50 cents of that, about half that goes straight to profitability. Even after you factor in everything that costs to run a company with its employees and share-based compensation and all the nasty stuff that takes to run a giant company like this, even after all of that, you can see the metrics for this company are absolutely incredible at around 50%. And of course, not only are the metrics good, but the long-term track record of this company is growing year after year after year, which of course the profitability is doing the same as well with those great metrics. And as you may have guessed, the dividend's doing the same, and so are the share buybacks being bought back every single quarter, which in fact, this actually has one of the largest share buyback programs in the world, buying back millions of shares every single quarter, now below 2 billion shares outstanding. So it's one that I like. It's a little bit higher priced. It has started to come down in price, but I think it's a buying opportunity. It's one that's high quality, one that people tend to overlook, and it's one that I'd probably be continually having at a high position in the dividend growth portfolio for years to come. Now, one that used to be the largest position in the portfolio was Broadcom, ticker symbol AVGO, AVGO, but now sits at around $400 per share. When we started reaching $500, $600, almost $700 per share, I decided to start decreasing in the portfolio. I didn't decide to tell anybody to sell shares or anything like that. I just wanted to lower the target weighting because right now it's at 7%. I believe at the peak, I believe it was around 9-10%, and so I've lowered it a little bit. The company's dividend yield has gone up as the semiconductor industry has come down, and many of these semi stocks have finally skipped a beat in terms of their share performance. Now, this company was, like I said, almost 700, and now it's come down all the way to 444. Year to date is down 33%, but this company has continually grown through M&A activity. M&A, of course, standing for merger and acquisition. This company has either merged or bought out so many different companies, which is why you see the ticker symbol AVGO, by the way. That's short for Avago with a merger they did years ago, but that's just a fun fact. You can see that in the last year, look at the growth from 24 billion up to 27.5 billion, and this is for a company that is finally starting to diversify out of the semiconductor industry. This is not just a chip company anymore. This is also a software-based company. They just bought out VMware. If we hop over here and we look at the quarterly numbers, you can see that right now you're starting to see a trend higher and higher, and part of that is not only because of their semiconductor growth, but you're about to see a big ramp up from their acquisition from VMware. This company bought out a multi-billion-dollar company that was a software-based giant. You can see that quarterly, this company has been growing on a long-term track record, but you can see that this company continually grows quarter after quarter after quarter, most recently putting up about $3.5 billion in revenue every single quarter. And then, of course, putting up that nice profitability as well that's going to go to, you guessed it, AVGO, ticker symbol AVGO, which is Broadcom. Now, this is already going to continually go higher, not only from its old school business, but its new purchases into software as well. And I think it's a really interesting play, and it's shocking to me that with this company being a $180 billion market cap, that so many people ignore it and overlook it. It's one of the best high growth dividend raisers that you've seen in the market that people tend to ignore. 5 years ago, this was paying $1.75. Today, it pays $4.10. That is well over a double up in a 5-year span in terms of its dividends being paid out, while the shares have gone up 83%. If you want an interesting play right now, where the company is at an opportunity where we're about to see record levels of revenue, likely record levels of profitability, which we're already looking at right now, I think now is an interesting time to be picking the shares up at around $400 a share. So we might be adding this and increasing it in the future. We'll stay tuned. Now, the last REIT, the last real estate investment trust in the portfolio that you'll see today is Vici. Now, you notice that I'm really heavy real estate. I like to only pick a few names because I think that a lot of real estate investment trusts, there's a lot of fluff. There's a lot of not so great REITs out there. There's really only a few names that are really high quality. And WP Carey, Realty Income, and then lastly Vici are really one of the only ones that I really like. There's a couple names that are on my watch list, but this company is really, really high quality. Now, they basically own the Vegas Strip, if you're not familiar. We talked actually the other day in my recent video, talked about Realty Income made a huge purchase with Wynn Resorts and how attractive it was for Realty Income, and many companies are overlooking these awesome gaming investments. Well, they're just catching up with the times because this is something that Vici Properties has been doing for like a decade now. This company has continually bought out gaming properties all over the Vegas Strip and alike for years and years now. This company has done a good job of getting its share price up and raising that dividend from 16 cents up to today's 39 cents, over a double up, but more importantly, the actual fundamental business, which is what we really care about, is what is doing great. If you look at the track record, you can see at this company, through its form of purchasing other properties and making deals through mergers and acquisitions, has been great. We are now reaching record levels of revenue, record levels of profitability. You can see this big jump up here from the closure of the Venetian, and they have contracts that are decades upon decades. I believe the Venetian was actually a 100-year contract, which has CPI adjustments built in. So over time, with all three of these, with WP Carey, Realty Income, and Vici, as inflation rises and prices go up, the rent is already factored in to increase alongside it. So if you're worried about these companies not being able to finance their properties, not being able to pay the bills, well, guess what? Whether you like it or not, these companies own the land that these properties are built on, and rent escalations are already built in. So it's almost guaranteed revenue growth, almost no matter what, as long as we don't go into some massive depression. Now, don't expect these companies to double up. They're very boring, slow investments. I don't ever expect something like a Vici to be $30 today and be $60 next year, but they're going to be slow, steady growers, slow, steady compounders that are going to continually be slow growing stocks that pay out big dividends over the next decade. That's what I'm focusing on, and that's why I own these three REITs. Next, we have Home Depot. Home Depot is one that I've loved. It's one of the best physical stores that you can find. It's really one of the only brick and mortar stores that I really still like. There's not many that I like left, and this is one that, once again, long-term track record. Do you see a pattern here? Do you notice with all these companies, I like compounders, I like growers, and I like companies that get more efficient. We talked earlier about Visa's ratios, and you can see that the same kind of story plays out here with Home Depot. Ever since they had the Great Recession, they really revamped their business. You can see that they had return on capital employed at around 25 to 30%. Nowadays, you see numbers around 50%. Last year's 53%, and the same thing goes for all these, whether we're talking about gross margin, operating margin, profit margin. They're pretty much going higher and higher over time. So not only are they growing their business, of course you can expect this business to grow, but they're getting more efficient, which of course leads to a better deal for shareholders, which leads to a higher dividend, which leads to share repurchases out the wazoo, and of course creates opportunity for shareholders. This company is now about to go below 1 billion shares outstanding, which is pretty incredible considering around the time I was born, they had about 2.5 billion. Now they're about to break up below 1 billion, meaning they've already bought back over half of the company stock back by themselves just in the last 2 decades, which is absolutely crazy to think about. Home Depot's run is not over in my opinion. I think that this is one that is likely going to be around a very long time, maybe even longer than me. We'll see how it adapts to the Internet of Things and how the world changes, how Home Depot will shift its business model, but it's one that as of today is one that is still being purchased in stores, and one of the products that they sell is Whirlpool. Whirlpool is next on the list. It's one that I love because it's like finding a diamond in the rough. It's like you're going looking for gold and you look through 1 million acres of dirt and you finally find that one golden nugget that no one else decided to look for. It is a very boring company. It is let me repeat that. It is very, very boring. Let's look at the ticker symbol and let's look at the growth of this company. The growth is boring. It's a snooze. It's basically flat. Let's look on the annual chart so we can go even further back. Basically went nowhere for almost a a decade, you can see that it's went up a little bit, but it pretty much stays flat. The only way that the company really grows is really with inflation as prices go up a little bit. But if you notice, the net income is going up. If you notice, the free cash flow is going up not only a little bit, but going up dramatically, over doubled in the last 2 years. You look at the dividend, it is skyrocketing. You look at the shares outstanding, they're buying back stock at a level that is pretty much unprecedented. You can see that just, let's go back about 5 years or so ago. This company had about 75 million shares outstanding. Today they have 56. They are buying back ridiculous amounts of stock. And this is just one that no one will ever pay attention to because it's not a sexy business model. Washer and dryers, garbage disposals, dishwashers, these are not the type of industries that people are focusing on. But if you're willing to weather the storm and just hold on to your shares, you're going to get steady paying 5+% dividend yields and massive amounts of share buybacks. The return capital to shareholders for this company is ridiculous. If this company can just stay flat, they don't even have to grow. Let me pull up Qualtrim here. I keep on clicking the wrong tab. If you just look at this revenue chart and you say, okay, can they just maintain this? They don't need to grow. They don't need to have massive uproar. Can they just keep the same level of what they're doing? Can they keep this 1% growth over a 10-year period? If they can at least do that or stay flat near it, this share price will likely go up over time as they buy back ridiculous amounts of stock and then keep on raising that dividend. They're in great financial health. If you look over the most recent quarter, you can see that their debt was about, let's pull up the debt. It was $4.8 billion, and the cash is still at $1.6 billion, which should be raised up after they finish this acquisition. But the acquisition, of course, is just going to raise the revenue and the profitability as they just bought out a division of another company that sells garbage disposals, which should increase the revenue. I think that this portfolio has a unique opportunity to add boring defensive companies like Whirlpool that people overlook because you're only focused on the cash flows of this portfolio. You're not focused on high flyers. You're not focused on investing in companies that are growing crazy like a Tesla. Tesla is a great company and it's one that I like, but it's very volatile. You can see over a 5-year period, it goes up, swings up and down like crazy. It goes up all over the place. If we're investing in high-flying chip companies like an Nvidia, Nvidia is great, but it is all over the place. You see massive uproars and then massive downturns. That's not what we're focused on. We're focused on steady compounders. In the same way we talked about Nvidia, you can see that its profitability is all over the place along with the stock price. If you look quarterly, you can see that pretty much over the last couple of quarters, its profitability has evaporated. Originally doing $3 billion in profitability, its most recent quarter was $600 million. It's went down about 80% just in 6 months. And that's why you see a massive downturn in share price from this company being $300 plus to today's $120. It's cut in half. When you see companies like this, they're high growers. When times are good, they do really well. When times are bad, they don't do so great. A company like Avgo, ticker symbol AVGO, has not had as big as a downturn. It has only went down about 30% because its revenue and its profitability is more steady. You can see that its profitability has hit a little bit of a downturn, but not really. It's pretty much consecutively gone up quarter after quarter. And that's what I want to look for with these companies. Same thing can be said about Pepsi, another boring company that's extremely defensive, one of my favorite, and being such a big fan of Doritos and Mountain Dew, I can't just not invest in this company. You can see it's a steady, slow grower as people continually eat more and drink more and the population goes up. This company's going to benefit, and they try to acquire accretive brands like Rockstar they bought 2 years ago to continually grow this number up. You can see that it has spikes up, spikes down depending on the quarter, but you generally get the point. If you look on an annual basis, the revenue goes up as well as the profitability. This company continually raises its dividend, has like a 50 or 51-year streak, I can't remember, raising the dividend. It's decades in a row now. One of the best things too is that it's one of the most defensive stocks in the entire market. You can see that year to date, this company's down 5%. In a time where the market, let's search the SPY. The SPY is down, let's see, year to date, it's down 25%. While a company like Pepsi is so defensive that it's only went down 5% year to date. Year to date, it's only down 5%. That's because it's a defensive company. You guys all know it, you all love it, and it's one that I'm interested in investing in. Now, next up on the list, we have ticker symbol MMM, which is 3 3M, and it's hit a big downturn. I made a whole dedicated video to this company, so go watch that. I've titled it 3M Has a Growth Problem. So you can either search that video in the YouTube search, or you can look on my channel. I posted it just a couple weeks ago. So take a look at that. So I don't want to go too deep into this, but long story short, this company is in a weird spot. They're not really growing. They're not really getting much more efficient, but they're so darn cheap. And they have a 5% dividend yield. It's one that I go back and forth with. I really don't know. I'm kind of just at a hold, and it's at a midpoint in the portfolio. And that's kind of, actually, it's funny we're leading into this because this goes hand in hand with the next company, which is Altria. It's a business that it doesn't have a great outlook. It's not growing all that much. And the growth that it does has, it's just because it's raising prices on people that are really addicted to its products. If you look on a quarter-over-quarter basis, you can see that this is pretty much flat ever since that spin-off in 2006. They have stayed pretty much flat with very little growth. And including their profitability, you can see that it's done a very similar thing as well. It's kind of went up these last couple of years, but not really. For years on end now, it's pretty much stayed flat. And these two companies are ones that are not really growing, but they have very high yields. Altria currently yields 8.75%, and it raises that dividend every year. So I don't know, stay tuned. I always go back and forth with these. I don't really know what to do with them. They're in the core holdings right now, and they're not being left or adjusted with right now, but stay tuned. Target is one that we took advantage of as this big downturn. It's one that I've liked for a long time. This is one that has grown considerably well despite all the economic recessions that we've had and all the turmoils that we've seen. You look during 2008 and 2009, when we were going through the Great Recession, this company actually increased its revenue. In 2007, it was $59 billion, up to $63, and then $64 billion. It's never really had a year other than this 1 year in 2005 and 1 year in 2017 where it's really taken revenue down. You see this beautiful revenue chart, and it's just pretty much up and up and up after a year. You can see that on a quarterly basis, though, we're finally starting to hit some headwinds where it's starting to flatten out. Now, that's just because this company grew so much in the last 2 years, as you can see from these huge ramp ups here, that it started to finally hit a wall on how fast it can grow, and people are starting to spend less. That said, investors are scared. Profitability has went in the toilet. Now that said, do I think that this will rebound? I absolutely do. Target is not dead. Target is not going anywhere, and that is why I decided to pick up some shares for a decent dividend yield of 2.5% as they continually grow it as well, but more importantly, buying shares instead of this high price of $260, we're buying them today at around $150 a share, $148 as of the most recent close. Now next up on the list, we have Kimberly Clark, one that's very boring. Kimberly Clark, I'm not going to talk about very long at all because I just made a video, so go check that out. I just made that last week, so go watch that if you're interested. But Kimberly Clark is a boring, slow grower that's very defensive, and the share price is not volatile at all. This is actually one of the only times I've seen it go down considerably other than the 2020 crash, but this is one that just sells basic paper products and people need and use, and a fourth of the world's population use them every single day. Next up, we have Verizon, one that has kind of shocked me in the last year, going down 30% and year-to-date down 27%. This is one that is very boring, very slow grower, one that people typically overlook and basically put in the basket as another AT&T. Now this company, let's just look at the quarterly charts. It is basically flat since about 2015, 2016, going basically nowhere. And the bad part is that the share price, despite this company maintaining its revenue, people are not willing to pay the amount for the cash flows that they used to for this company as interest rates have gone up. And the one thing that's big scary on investors' minds, if you look at the year over year, you can see that the company's debt pile has continually risen. And this gets more apparent on a quarterly basis. If we take away the capital leases and the cash, you can see that debt rising over time, up higher and higher, and the most recent reported $132 billion. Meanwhile, the cash is $1 billion. This company has net debt of $100+ billion. Now that said, they pay out a great dividend, they're extremely defensive, and it's one that looking back now, I might have not held on to so long. It's a very small position in the portfolio. I might move this out into another position. I don't know, stay tuned, I'll decide later. But as of now, we still hold it, and we might be selling out. I don't know, I'm still deciding. Next up is Procter and Gamble, a core holding that I don't ever plan to remove out of this portfolio. Still up 38% in the 5-year track record. Continually raise the dividend, and it's one of the most boring companies in the market. If you walk in into Walmart, they practically own the Walmart shelves. It's basically them and companies like Unilever that sell household products every single day, and this company has a massive suite of products. So many incredible brands that you know and don't even think about twice. Whether you're thinking about Tide or Gain or so many other names out there, Procter and Gamble likely owns it, and they're going to sell it to you every time you walk into Walmart or Target or another competitor such as that. Now we have one energy play, which I don't go over very much because I'm not very competent on energy, and I have it a very small weighting just as a diversification play, and this company continually raises its dividend and has done very well over the last 5 years, and I think that will continue based on the research that I've done for this company. Next up, we have Caterpillar. We're getting towards the end here, the smaller holdings. It's one that's great, and it does do very good in booms of the market, but does very bad during busts of the market. You can see during the time that this company hit its peak year to date, it has gone down 20%. Since then, on a 1 year period, it's also down a similar 17%, but this company does do very well during good times, so when we do finally recover in the market, I expect it to do very well, but during recessions, it does get hit hard. Its profitability gets hard, and you can see that it's starting to finally eke out into the numbers. If you look at the quarterly basis, its net income is finally started to flatten out, if not go down, versus the 2019 numbers, but I think it could very well go down a lot more as we get further into this recession, unfortunately. So stay tuned for that. McDonald's is one that's just a steady, slow grower. We all know and love it, and it's finally starting to hit a downturn. It was just $2.57 like a week ago, and today it's $2.30. So that's about a 10% downturn for McDonald's, which is pretty rare to see a company this size and scale do that because it's normally not volatile at all. But this company is pretty high priced. It's at a pretty high valuation, so I have it at a very small weighting in the portfolio. And the same thing could be said about Coca-Cola. You know both of these business models, McDonald's and Coca-Cola, they're very boring. You all know them. And they're steady, slow growers and continually produce return capital to shareholders, but they're at valuations that I don't find very attractive right now. So I have them at 1% holdings. But that's pretty much it for the portfolio. That's the 20 in the dividend growth portfolio. And then of course, here's the 4 in the growth portfolio we talked about earlier. But that's pretty much it. Thank you for everything that you did. Thank you for all these views. I appreciate it so much. Check out all the stuff down below in the description that we talked about, including M1 Finance referrals. But without further ado, guys, thank you so much for watching, and I'll catch you guys next time.